Ever wondered where the big players park their cash when they're not ready to deploy it? Or maybe you're just looking for a safe harbor for your own funds, a place that offers stability while still potentially earning a bit more than a standard savings account. Well, you've landed in the right place. Today, we're diving deep into the world of money market funds, specifically exploring some examples offered by one of the giants in the investment world, Fidelity. Now, before we get into the nitty-gritty of specific funds, let's take a step back and understand what exactly a money market fund is. Think of it as a mutual fund that invests in short-term, low-risk debt securities. These can include things like U.S. Treasury bills, commercial paper, which is basically short-term debt issued by corporations, certificates of deposit, CDs, from banks, and repurchase agreements, repos, which involve the short-term sale and repurchase of securities. The primary goal of a money market fund isn't high growth like you might see with stocks. Instead, it's all about preserving capital and providing a stable net asset value, NAV, which they typically aim to keep at $1 per share. This stability makes them attractive to investors who are looking for a safe place to keep their cash liquid, meaning easily accessible, while still potentially earning a modest return. Why might someone choose a money market fund? There are several reasons. For individuals, they can be a great place to park cash that you might need in the short term, like for a down payment on a house in a few months or emergency savings. For businesses, they can be used to manage working capital or temporarily store profits before reinvesting them. In times of market uncertainty, some investors also move assets into money market funds as a defensive strategy. Now that we have a solid understanding of what money market funds are all about, let's turn our attention to Fidelity. Fidelity Investments is one of the largest asset managers globally, offering a wide array of investment products, and their money market funds are no exception. One of the most common types of money market funds you'll encounter, including at Fidelity, are prime money market funds. These funds invest in a diverse range of short-term debt securities, including those issued by corporations and banks. Because they can hold a slightly wider range of securities compared to government money market funds, they might offer a slightly higher yield, but this comes with a potentially, albeit still small, higher level of credit risk, the risk that an issuer might default on their debt. An example of a prime money market fund offered by Fidelity is the Fidelity Cash Reserves, FDRXX. This is often considered one of their flagship money market funds. It aims for a high level of current income consistent with the preservation of capital and liquidity. The fund invests in a variety of high-quality, short-term money market instruments. It's important to note that the specific holdings and yields of this fund will fluctuate based on market conditions and interest rates. You can always find the most up-to-date information on Fidelity's website. Another category of money market funds is government money market funds. As the name suggests, these funds primarily invest in securities issued or guaranteed by the U.S. government and its agencies. This typically includes U.S. Treasury bills, notes, and bonds, as well as securities issued by government-sponsored enterprises like Fannie Mae and Freddie Mac. Because of the backing of the U.S. government, these funds are generally considered to have the lowest level of credit risk among money market funds. However, this lower risk often translates to potentially lower yields compared to prime money market funds. Within the realm of government money market funds, there's also a subcategory known as Treasury money market funds. These funds take the safety aspect a step further by investing exclusively in direct obligations of the U.S. Treasury, such as Treasury bills, notes, and bonds. This eliminates any potential credit risk associated with government agencies or sponsored enterprises. As a result, Treasury money market funds are generally considered the safest type of money market fund, although they may also offer the lowest yields. An example of a Fidelity Treasury Money Market Fund is the Fidelity Treasury Money Market Fund, FZFXX. This fund invests solely in securities issued by the U.S. Treasury. If your primary concern is safety and you're comfortable with potentially lower returns, this type of fund might be appealing. Beyond these main categories, Fidelity also offers tax-exempt money market funds, also known as municipal money market funds. These funds invest in short-term debt securities issued by state and local governments. The key benefit here is that the interest income earned from these funds is typically exempt from federal income tax, and in some cases, state and local taxes as well, depending on your residency and the issuer of the security. This can be particularly attractive for investors in higher tax brackets. An example of a tax-exempt money market fund from Fidelity is the Fidelity Municipal Money Market Fund, FDEX. This fund seeks to provide income exempt from federal income tax by investing in short-term municipal obligations. If you're looking to reduce your federal tax burden on your short-term savings, this could be an option to explore. Keep in mind that the yield on tax-exempt funds might appear lower than taxable money market funds, but the after-tax return could be more favorable depending on your tax situation. It's crucial to understand that while money market funds aim to maintain a stable $1 NAV, this is not guaranteed. While breaking the buck, falling below $1 NAV, is rare for well-managed money market funds, it is a possibility, especially during periods of significant market stress. However, regulations put in place after the 2008 financial crisis have aimed to strengthen the resilience of money market funds. When considering any money market fund, including those offered by Fidelity, it's essential to look at a few key factors. Yield is probably the first thing that catches your eye. This represents the annual rate of return you can expect to earn. However, remember that higher yield can sometimes come with slightly higher risk. So, to recap, Fidelity offers a range of money market funds designed for investors seeking safety, liquidity, and a modest return on their short-term cash holdings. These include prime money market funds like Fidelity Cash Reserves, FDRXX, government money market funds like Fidelity Government Money Market Fund, SPACs, Treasury money market funds like Fidelity Treasury Money Market Fund, FZFXX, and tax-exempt municipal money market funds like Fidelity Municipal Money Market Fund, FDEX. Each type has its own characteristics in terms of potential yield, risk, and tax implications. When choosing a Fidelity money market fund, or any money market fund for that matter, it's essential to carefully consider your own financial goals, risk tolerance, and tax situation. Review the fund's prospectus and fact sheet to understand its investment strategy, fees, and historical performance. And always remember that while money market funds are generally considered low risk, they are not entirely risk-free, and their yields will fluctuate with market conditions. With that said, thanks for watching, and until next time.